Hi everyone, welcome to part 2 of lesson 1. I wanted to talk about this lesson and lay down a lot of ground in a very basic explanation in what the stock market is. The stock market is a market where public companies are doing is that they're selling portions of their companies to people who want to buy them, right? And then the people who buy them, there's going to be people who want to buy what those others are buying. So the ones who bought first will sell that share to another person. But you're owning a share is an ownership of the company. So a public company distributes ownerships of their companies throughout shares to people who want to buy those shares or sell them. Now, there's another part in the market that it's called private equity. It's somewhat called private equity markets where that's a bit more secluded. You do need to have a much more money, about millions of dollars, in order to even, let's say, somewhat qualify or for a company to take you seriously to invest in a privately holded company, right? So an example of that could be Subway or Mars Chocolate, right? Mars Chocolate is the big brand that owns Milky Way, Snickers, and all these different types of chocolates because they're a private company. That also involves Chick-fil-A. These three companies aren't public companies, so you're not able to buy or sell them in any public traded platform. You have to talk to the company directly, right? And you have to have some sort of, let's say, qualification to do that. There's many different perceptions in what people perceive what the stock market is. Well, a lot of people, I think majority of a lot of people think it's like a gambling casino, right? And where people are buying and selling things and stocks go up and people make a lot of money and people sort of others view that and they want to get to the stock market to make a lot of money. And there's also, let's say, a bit of the academic part where people just want to retire from the stock market, or a lot of people are involved in IRAs or 401ks or in pension funds. Yeah, out of all this, stock market is only a distribution network, an exchange where you're able to buy portions of a business. That's all. That's all it is. And there's going to be people who want to sell the business to a person who wants to buy the business at a certain price. So that's why you see the stocks going up, because people are willing to pay a certain higher price to hold the business because they're optimistic on the business, which is the stock, right? But a lot of people review this the opposite way, because a lot of people around the world view the stock market as something that bounces up and down and in charts where people make a lot of money and people lose a lot of money, right? That's a very black and white way to see about it. And I'm going to explain to you why eventually very soon in the upcoming videos. But I wanted to explain to you exactly what the stock market is on that part. Many of you might be saying, like, what happens when you buy a stock? Like, what happens when you buy a share of a company? How do I even buy a share? Well, in order to buy a share, right, you need to open an online brokerage platform. And we're also going to lay this all down as well in the upcoming videos. I'm going to explain actually very specifically at least what brokers I know that can probably work for you. But make sure that these brokers are well fitted towards your own financial circumstance, right? And make sure that it's your preference, right? It's what you're looking for. Because there's some brokers that have sort of limitations in the accounts depending on what location you're in. I also know a lot of other accounts that can help you with margin, which is a completely different topic that's not investing. That margin is utilized mostly for trading. A lot of people typically like to use margin for investing, but the way how I've learned to invest and have grabbed from many people who are very professional investing, like Warren Buffett, Peter Lynch, and Ray Dalio, I've learned that over leveraging and when you're investing in a company can be extremely dangerous, and especially when you don't have the cash either. So that's why I don't invest with margin, and I don't even recommend anyone to invest in margin. I think it's a terrible decision to do. A lot of stocks in the short term that many people see them to go up and down, right? That sort of movement happens in the short term, right? The stocks can go anywhere they want. They can completely crash down, they can go up. Anything can happen. Let's say you want to buy Apple and you want to buy at 100 shares on $100 on the share price. So that means you're looking at the stock and you see that Apple cost $100 and you decided to buy 100 shares. So it'd be $100,000. But let's say that you only have $50,000 in your account. So what you would do is, let's say you have a margin account and your broker is able to lend you double of what you have. So that in total, because you have 50K, they'll lend you another 50K for you to open any positions or any investments, and you're able to utilize your broker's money and your money as well. Never do this, because if you decide to enter a position like this, the problem with leveraging is that if the stock goes down, which it can, because the stock market goes up and down in the short term, which isn't a business, but when the stock goes down, let's say it went down to $50,000, which would be half. Let's say Apple is something horrendous happens into the company, which won't happen, but let's say something macro, which is much more, something macroeconomically happens to the economy, and Apple is still making money, but the stock in the short term is completely crashing because everyone is pessimistic. That will make the stock, let's say the stock was at $100 and now it went down to $40. So it's about a 60% drawdown. Your account basically went down to 70%. And the problem with this is that when your account gets low up to that point, when you now have $30,000, the more the broker is going to block that amount. And by the time, let's say Apple, which can happen, let's say Apple went down to $20 per share, which is an 80% drawdown. And this all happened in 2022 with Amazon and many big companies went down so much and everyone got scared, where majority of all those sells, all those sells and all that short selling. When you're short selling, you're betting that the price is going down. That's what it means. It's called shorts. People call that shorts. And you basically do this by selling shares to another person who wants to eventually buy them at a certain price. But as a seller, you benefit more when you sell at a high price and you buy it back at a lower price. Just like in business, right? When you want to sell something, you want to sell high and you want to buy back low. That way, that difference there, what you bought back low, is much lower than what you gained in selling. So net in total, you're making money. The other one is going long. I don't know if you guys heard of that before, but going long is when you buy a share and you're betting for the share price to go up in the long term. So that means that you're going long in the stock. Right. So just so you can, because I'm going to mention these words if a lot of times you guys can be on the same page as me. And bullish is the same thing as going up. When you're bullish, that means that you think that the market's going to go up. You see that the market's going to go up more likely than to come down. And when you're bearish, you see the market to go down more than what it can go up. Right. So when you're bullish, you have more probabilities that you can see the market can go up. And when you're bearish, you can have more probabilities that you see the market can go down. Right. So, but the problem with margin is that if Apple is now worth $20 and you bought it at 100 shares, your broker, because your account value is below $25,000, the huge problem with this is that the majority of every broker, you have to have a minimum amount of 25K. Now there's certain, take this as a sort of grain of salt, because there's some brokers out there that do require more. So I'm just giving you only an example. This isn't the case for all brokers. Please make sure, I'm not saying every broker has a minimum amount to have in your account, $25,000. Make sure, call your broker call your broker to know what's the minimum amount you need to have in your account to have a margin account. But majority of a lot of brokers, you need $25,000. If your account goes below $25,000, even though you know the business of Apple will do well, or you know the company or the stock will do well, whatever your anticipation is, you will lose money. The reason why is because, think about it. The broker is not being nice to you. It's a business. No one's going to lend you money for free because they think you're a nice person, whatever. That's not what's happening. When the broker lends you money, they see you more likely to return, or at least they have a system to know whether you're viable to have margin or not. So that usually happens. They check out your income statements to know whether you're viable to have margin. Why? Because they're lending you money. It's the same thing as a credit company. It's like having a credit score, right? If your credit score gets higher, more credit lenders are able to lend you money much more easier because you're much more trustworthy. You're on time payments. You don't leave any balances on your account. You utilize a very low percentage of your whole account utilization rate. So it's the same thing with brokers. Just because the broker gives you margin and they give you double the money don't think of it as free money. In fact, they actually charge you interest per year. So it's not exactly, just because you have margin doesn't mean it's better. Right? And it's not good for investing. Many people in the short term reflect the price movement of the stock. So if someone tells you that Apple is doing something bad out of one area, let's say that they got involved in somewhat in China, there's a bit of supply issues and many of the media is talking about it, and that's causing your neighbor, your friend who's a millionaire to sell because they're also explaining to you that economically in the future there's going to be a recession. What are you likely going to do if you don't have much knowledge in the market? Well, you're probably going to sell, right? And this selling, as you do this, and many people are talking about it, the more people talk about it, the more it's going to happen. But when you sell something, automatically, psychologically, when you look at the charts, the stock's going down, when you see the prices going down, and it keeps going down, and it keeps going down, you start to get anxious, right? And you start to become irrational. You start to get frustrated, and you tend to more likely want to sell because everyone else is selling and you think that there's a reason for that. And maybe when you entered, you start to counter argument what you thought was good towards the company. And your counter argument is just because the price is going down. So you tend to sell for that. So margin accounts only charge you interest when you use the broker's money. So if you have a margin account, but you only used your account cash, and we're going to talk about that more in depth. I'm just explaining very, very basic stuff so you guys can understand this. But when you use your account value, only your cash, not the broker's cash, the broker is not going to charge you interest. But if you use leverage, of course, the broker is going to, be more cautious of you because you're using their money. And when the account's going down, they have a system to utilize their risk because it's a business. They have to stay profitable. When their credits and loans relate to loan and their lending is going sour, where it's losing value, they tend to cut that risk by forcing you to sell your position. And that's terrible because that will give you a loss, right? And obviously that's just a bad connection with the broker. You lost their money and you also lost your own money, but you lost more money than the broker because the broker is at least recovering a percentage of your money by charging you an interest. So you see, this is a whole business. There's going to be so many people, I'm telling you, and that's the problem with a bit of in the media, that a lot of people try to sell you on these things. Many people think that it's beneficial and they sell you that it's for your own good, but it's not, right? And it's very dangerous if you don't have, let's say, the right mindset. Most of all, you don't have the right mindset and the right expectations for what you're doing. Because if you're long-term investing in a company, you really should not care where the price goes in the short term. Not at all. What you care about is that the company that you're investing in makes more and more and more money, and that will always reflect the stock. And I'll talk about that more in depth. But I want you guys to get these basic principles, because one of the most important things that you have to do when you want to learn something is to also unlearn another thing and clear up your subconscious mind, because sometimes your subconscious mind plays a factor into this, where you try to do something, but you can't do it to the fullest extent just because your inner self, that subconscious mind, isn't letting you by simple habits and simple beliefs on what you don't understand. So I'm trying to lay down the ground and give you guys more options and more clarity on really what's going on in each area, so you can best execute each outcome based on your goals, right? So that's for the broker's part. But for the stock market, it's what I said. The stock market, the whole point, and I'm going to say it right up front, what you're going to learn in this course, I'm not going to tell you need to invest in this company and you should expect this amount of money or get into this industry because it's really good. Or that's not here. And I also don't have my own fund. I'm not doing any of that stuff, right? Because there's a lot of people do that and they're quite a bit of scams. But that's not here. I'm not here to show you this, right? I'm not here to do that to you guys. What I want, the whole purpose of this course, what you're going to learn, is how to fish. I want to completely dedicate a lot of my time to teach you how to fish. And simultaneously, you're going to also, while you're learning how to fish, you're going to see live how I go about fishing. And you're going to learn the way how I fish, because the way how I constructed my fishing was a lot of the parts and pieces that I've learned from many people who have decades of experience ahead of me, who are Warren Buffett, one of the greatest investors of all time, Charlie Munger, Ray Dalio, Lee Lu, Manish Pabbai, Peter Lynch, Phil Fisher, and Benjamin Graham, and many of these other people, Joan Greenbelt. There's quite a bit of investors to learn from, but I've dedicated many years into seeing how I can somewhat emulate these different structures of investing into one place and see which one gives the best possible outcome towards your own goals. So the cool thing that I really liked from my own conclusion out of learning and researching all this stuff for many years is that I found that each one is powerful based on the expectation you put on it, right? And that's the great thing about it, because in this course, you're going to have so much variety, and that's what I want to create. I want to create a lot of variety because many people have different circumstance, and maybe they have different financial circumstance, or they have different investment objectives. A lot of people want to just save up to retirement. A lot of people just want to try to grow their wealth in 10 years. Any one of these persons, whether you're an elderly person, whether you're 60, 70, 50, 40, or 20 years old, this investment plan works for anyone, regardless of age, and that's why I love it. I want to congratulate on that because you took your first step into this, and you now know what a stock market is. Into that, you know that when you buy a share, you're buying a ownership piece, a part of the company, and trust me, that's the most important step that many people don't get, even getting the market. Because a lot of people, when they get into the market, they just look at charts and they think that, okay, when you break here, you buy here. It doesn't work like that. It's much more bigger than that, right? That's for trading. You don't invest in stocks, you invest in businesses, and you're guaranteed to make a return if you know that business as well. Because it's the business, it's not the stock. The stock can do anything, and the stock market has done anything it wants to do. Trust me. I've seen from many different investors how they fall in rows as well with different circumstances. And I myself have studied many different market events, including ones before my time, before I was born. I looked at the markets back in the 1800s till now, and I was able to see how relevant and how important were certain factors to have in the market in that time, and how that can relate to now. In the stock market, there's also, it's really called equities in total. Equities are stocks as well, but there's also going to be different securities. And securities, when I talk about securities mean investment instrument, right? It's like it's an asset in a way. It can involve stocks, bonds, treasury assets such as treasury bonds, really, partnership interest, oil and gas, many different things. But in many of the securities in the market, you have indexes or indices, in most of all indexes. For example, there's an index called the S&P 500, right? S&P 500. I think you guys heard of it, maybe not. But either way, the S&P 500 stands for the Standard & Poor's 500. Now, why does this matter? Well, the S&P 500 is an index, and the S&P 500 only tracks the 500 biggest companies in market cap in the world. That index is very powerful, and it's a great security. It's a great investment to have in that security because you're investing in a wide range, in a wide basket of the 500 biggest companies in the world, right? And these companies are the good thing about the indexes is that they change, not all of them, but for the S&P 500, they always adapt and change which company is relevant and how reliable are they in their sales and revenue, and also in the market cap. They already factor all this in, and if it passes in this sort of test, that company is able to be included back into the S&P 500. But keep in mind that they're all 500 companies. So usually when they include a company, they exclude another company. And the company that can be excluded will be a company maybe that it's losing an economic advantage, it's losing a business advantage, maybe it's not making as much money as it used to be, and the prospects of it making future money is very, very low. So that's a great thing. And also the biggest companies, 90% of every big company in the world is all in the United States. So when you buy the S&P 500, the greatest thing about it is that first, it was created in the United States, and inevitably, of course, that's going to have a lot of the US companies in it, but the majority of every company in the S&P 500 is filled of all the biggest companies in the US. So you could really say that the S&P 500 is also the US economy, because you're investing in the 500 biggest companies pretty much in all the US. So you're when you buy this, what you're really saying is that you're actually net bullish in the United States. You're net bullish in North America, right? And that's a fantastic way to go about in the market. And we're also going to cover that. I love investing because there's so many ways to have high results in it. Now, of course, when I mean many ways is that there's so many different disciplines, right? Because it doesn't mean that there's a full abundant ways, or else everyone would be doing well in the market. But there's very simple ways, very, very, very simple ways that people don't do because of how simple it is. And people don't believe it. And most of all, people just see it to be too boring. And most of all, they don't understand. That's where the expectation is. They don't put the right expectation on the certain instrument, and they rather trade and try to be rich by making $1 million in a few months. So that's not what we're here for. We're only looking at the long term. In the long term, you're always going to make much more money in a surest way compared to the short term. And that's all what it's about. There's another index called the Dow Jones Industrial Average. The Dow Jones is the first index ever created back in the 1800s. Right now, it still exists. Now the S&P 500 is the best, and it's been for many, many decades. But back before the 1920s, the Dow Jones was the biggest index in the world. It was the only index. So back then, if you wanted to invest in the United States in total, you would buy the Dow Jones, right? So the Dow Jones, though, so you guys can understand, what is exactly the Dow Jones? Well, the Dow Jones Industrial Average is an index. It's the same thing. And This index tracks 30 of the blue chip companies in the world. So what does blue chip mean? Because that's an abbreviation in markets, right? So blue chip company is a company highly recognizable to anyone, right? It's a company that's super big. It's a large market cap company. It's a business that has a long history, right? It's been running and making more money, has expanded their brand awareness, and has had such a sturdy, low debt balance sheet. You could say really an A+ company in the world. And of course, these companies could be like Coca-Cola, right? Coca-Cola, why? Coca-Cola is, I think, one of the most powerful brands. No, it is. Coca-Cola is the most powerful brand in the world, and it has been for such a long time. Coca-Cola has had a history with such a low debt because of the way how their business is. They don't need to get into debt. They can just keep selling Coke if they want to. People will still consume. And they've had such a long history of making money and increasing the revenues in a big exponential way without sacrificing the revenues by getting into debt a lot. So these companies include Apple, Microsoft, Coca-Cola, Johnson & Johnson, many of these different companies that you just completely recognize out of your head without any effort of thought. Those are called blue chip companies. So the Dow Jones has 30 of the biggest blue chip companies in the world. And that's a very powerful combination because you have, the greatest companies in the world as of right now in one index. Now, many of you might be saying, what's exactly an index though? What does it do? Like, why does this exist? Well, an index, the way how it's structured is that the Dow Jones has a portfolio, because it really is like that. It's a portfolio of these companies. So when you buy the Dow Jones, you're buying 30 of all these companies. And that's the same thing for the S&P 500. When you want to buy the S&P 500, that means you want to buy all of those 500 companies. And the great thing is that when you invest money in this index, is going to adjust their portfolio by excluding obsolete companies to brand monopoly companies to strong companies. And it will keep increasing more in value because their market caps are going up. So that's the same thing with the Dow Jones. The Dow Jones always excludes companies, and they always include companies. And they do this as their investments. They invest in this. And the price that you pay in the Dow Jones, it's a price that's adjusted based on all the company's equity by the total of shares and by the total of assets and liabilities too. So as you see in the charts, the Dow Jones has consistently gone up over years and years and years and decades. And what does that represent? That means companies 2, 5, 10 years ago, they were making money, but they've made more money 5 years later. They've made more money 2 years later. So it's a strong business. And this reflects most of all the United States, really. The United States has showed the strongest record in history in the world to grow in such an economic power because of the consumption of a company. And this is a fact. The reason why the S&P 500 and the Dow Jones Industrial Averages, these two indexes, have consistently gone up in many, many, many years is just because that overall consumption in the world, but most of all in the US, has gone up more and more, and people want to consume more in what they did in the past, right? And this will happen as long as the US stays intact. And many of you might be saying, well, okay, how do I know if the US is intact? Well, or maybe some of you might disagree with me. Maybe some of you are pessimistic on the US future, or somewhat neutral, or whatever, you're biased in a way. But let me give you this. In the past, there's been dozens examples. There's been dozens of situations in the US that had to go through struggle, and it always managed to get out of a certain scenario, not in a fantastic way, let's say economically. When I'm talking about, like, there's always going to be issues in the world, but out of a situation, the problem isn't, remember that problems aren't always completely resolved. And that's the case for countries as well. You try as best as you can to solve a portion of a problem, but maybe you're not able to fulfillingly succeed the problem completely because maybe there's a side consequence in that opportunity, and maybe it doesn't benefit for the whole society to go through. Maybe it's very painful for the short term. But despite that, we've had the Cuban Missile Crisis, 9/11, dot-com crash, Bond Massacre, we've 70 stagflation, we had the Smithson Agreement, we've had Louvre Accord, we've had the Bretton Woods, which is the same thing as Smithson agreement. You've had out of the Great Depression, right? You've had Hitler in World War II and Pearl Harbor, Korean War as well, and you had the Vietnam War. You had all these kinds of problems. We had COVID a few years ago, but all these problems that many people would completely shake their heads and just lose their minds on how bad everything is right now, right? But you need to remember the reason why an index beats overall many hedge funds. I'm not saying a stock. I'm not saying a company, but I'm talking about hedge funds and mutual funds and anyone that somewhat has a portfolio. The reason why the S&P and the Dow Jones outperform all these people is because they cover every company in wide areas that are the biggest companies. And throughout the long term, as long as consumption stays solid, which it will, because everyone wants a better world. No one wants to desire misery and poor commonwealth for everyone around them. No, everyone wants to have higher incomes. Everyone wants to spend more. Everyone wants to get a car. Everyone wants to get a house. Everyone wants a better life. Everyone wants a phone. That's the life that we live in. Everyone wants to be in the internet. Everyone wants to have access to things. That's consumption. So no matter what economic factors we go into, consumption will always stay strong, right? As companies produce as they shouldn't. And that will always happen. That will always happen because that's happened multiple times from history and also besides history, talking into now. People will still consume, especially when you restrict them, when there's a restriction to not consume much. And that's exactly what happened the Great Depression. That's what happened in World War II. That's what happened in 1952 when the Korean War happened, an attack, and many people got fearful because they thought Russia was going to bomb the US. So everyone decided to buy a house in the western side of the US, which pumped up prices ridiculously in real estate. Despite the bubbles, people were still consuming with high taxes and high inflation, with new cars and new all this. There wasn't immediate, let's say, repetitive buyings in that point, because in that time people bought an asset, and they wanted to hold the asset and refurbish it maybe 5 to 6 years later. So, but there is always strong consumption. There was consumption in the 53s. There was consumption in the 70s, despite the ridiculous amount of inflation and the ridiculous geopolitical problems like the Yom Kippur, I don't even know if I'm pronouncing that right, Yom Kippur War and the oil crash and ridiculous high inflation in the 80s. When you restrict someone from doing something, they're going to come back to want to have more. That's what happened in COVID. What happened in COVID? This is one of the best examples you guys can learn, let's say, that you can remember in your lifetime, because I don't know what the age range is going to be, people watching this, but let's say recently in COVID, which that COVID impacted everyone in the world, no matter where you were. And COVID impacted in a way socially. You know, you couldn't go outside. I remember that. You couldn't go outside. You had to stay for months in your house. It was a very unprecedented time. No one knew what was going to happen. Everyone in the markets thought that this could be an issue that could last for years and probably for decades. People didn't see it surprising for the market to stay down for 5 years more. It was a very, let's say, sour situation. But after the Fed did the quantitative easing, before that quantitative easing, when they pumped the amount of money that they injected, that incentivized producers and employees then from producers, but then I would say it benefited more producers, right? Because that eventually created a wealth gap. It's inevitable, but that affected more producers to publish a lot of ridiculous products at a bundle price. Because I remember in 2021, many companies were able to bring up their cash and their revenue skyrocketed because consumption's still going to last. What happened in COVID, when people stayed home, they wanted to still work. They wanted to be productive. In fact, many people discovered great things out of COVID, stuff like a new company and entrepreneur. People got more involved into Zoom. Many people got more involved into their own personal finances and to their own personal health being, and that helps the person that they're spending money in order to retrieve an understanding to better what they're doing. And that overall helps the economic system because the producers are able to produce and give more incentives and products for people to buy for, and hence that makes people happy. People are happy on things that they possess. That's just the way how it is. There's always going to be possessions for people. You know, people want to buy things. You cannot go to a country. I don't even care if you're in a communist state. If you live in a very communistic, socialistic place that every revenue is going throughout the state, of course, there's a lot of limitations with that. But everyone still wants to consume at the end of the day. And everyone who's involved very deeply in economics, deep down, I don't know if you agree with me or not, but we all know that everyone wants to buy and sell things. No one wants to not buy things. People want to buy things. People want to buy a burger from McDonald's. People want to buy Coca-Cola. People want to watch YouTube videos. People want to watch movies. People want to, I don't know, just they want to do hobbies. They want to do many, many, many things. And this is overall consumption, right? And that consumption strengthens because of the ability for the producers to provide that. And that providement is incentivized by the whole government structure that we have in this country, which is able to incentivize companies in a sort of way, which is it's a, Warren Buffett calls it he calls it the golden goose in the secret sauce, and that's the secret sauce. It's the fact that the government is well structured for the companies that way, that something economically is happening in the short term. Sure, there's high interest rates and this is going to affect companies in the short term, but the companies are able to be diligently thorough and invest and mitigate their debts and their plans, most of all in their businesses, in order to reach customers in a more effective way, in a more efficient way, in a faster way. And with these methodologies, this is obviously going to boost more consumption, and that consumption will boost other consumptions by their mentality, also with consumptions and brand awareness. So this is like a domino effect. That's why the S&P always goes up. America, I'm not a pessimistic about America. I don't know, maybe many people aren't, but I simply, because I think many people aren't because they don't understand. They haven't seen the facts. I've seen many factors, what plays into the United States ever since the 1800s. And way beyond that, I saw many different factors in, let's say, marketable securities in set public during the 1600s. That was during the Dutch Empire, right? That was during the Dutch Empire, which was the guilder currency, and way before that. So like it's I've really studied very closely currency, and it revolves everything. But I know a lot about markets. I know a lot about currencies. I know a lot about business and banks and a lot of this stuff because it revolves with each other. They interplay with each other. And I can tell you right now, and also what I just told you, that many of these things, many people call it the secret sauce. That's what Warren Buffett calls it. And that's why the United States, the index, like the S&P, is always going to go up. So I usually say to a person who doesn't know anything about the markets, if you're way too busy of a person and you don't have time, and you really don't have time to see better opportunities, but you don't want to miss out on a big gain in the long term, the best single thing you can ever do in your life, and I'm really saying that, in your life, is to put money down in the S&P 500. And I would say even put down money continuously, like, right, if you're getting a set income, a paycheck in your jobs or in your business, save a percentage of that income and reinvest that money always into the S&P 500. And I will tell you that investment, you are never going to regret that. You're not, because consumption will always rise. That's now more for me. That depends on other people, but I gave you the facts. It's just based on what you want to do. But for me, I've studied, and I'll show you in the upcoming videos, because I know I have so much data and facts and results that I could show you different assets and how they interplay with each other. But I can tell you that the S&P 500, specifically the stock market, but the S&P 500 is one of, I'm not saying that it is, because many people will distort the words that I'm saying, but the S&P 500 is one of the safest investments you can ever do in finance. If you hold it for the long term. If you sell it, it won't be any different than what 90% of everyone's doing, right? Because they get scared that the market goes down or up. That doesn't matter, because you only care about the United States. You care about the economy. Who cares if the market goes down? I'd actually be buying more, because that's a short-term thing. There's a net overall, that consumption is going to go up. That's what happened in the Great Depression. The Great Depression was the most biggest event that's ever happened in centuries in terms of economically, and it affected all over the world. The world felt the Great Depression. I mean, that's what made Hitler. But out of this, the U.S. was able to grow and make such enormous projects that we never would have had right now if it wasn't for the Great Depressions. You guys will see that out of so many crises, there were such incredible discoveries that are so essential now, and especially back then. It's super important. So the other second reason why the S&P 500 is always going to outperform hedge funds and anyone else is because At the end of the day, when you invest, there's no 100% perfect company to invest, and you know that you won't lose money, right? That's just nonsense. That doesn't exist. That's like the tooth fairy. That's fairy dust. That's a complete. I don't know. That's something that people thought of when they were on mushrooms and everything. That does not exist. But the most closest to that is the S&P 500. Is because hedge funds are a business as well, and inevitably the nature when you have more money to work with, but I mean a lot more money. I'm not talking about just a few millions of dollars or even a few billions of dollars. I'm talking about 50 to 60, 70, 80 billion dollars to work with, or more than that. The problem with that is that when you have too much money, the prospects of getting a good investment deteriorates a lot. Think about it. If you have $100,000 in your account and you're able to put a huge position, let's say you put 33% into, I'm giving this an example. This isn't something that you should do, but let's say that you put 30% into an investment. You know that that business is really good, and you distribute you distribute 33% in each investments that you found were amazing, wonderful companies that you would hold for your whole life, basically, right? For your whole life. You're that sure about the business. And these businesses, let's say in 20 years, they made about 1 to 80 after inflation. Yeah, that's about an 8,000% return. Well, that would be about each one of those. That would be like 333,000. No, I'm sorry, that's 33,000. Let's say that one made 8,000 return, the other one made 5,000, and then the other one made 6,000. Out of this, in 20 years, you converted $100,000 to 6.8 million dollars, and that's not even a fantastic return. Which many of you might be saying, like, wait, what the hell? That's not a fantastic return. No, if you reinvested many times. This is just a number figure. If you reinvested very low amount of times and you didn't really look at it much, but that's still a really good return, because that's about 68,900% in 20 years after inflation too, which is ridiculous. That's a ridiculous return, right? That's good. But the problem is that, when you compound this return and then you start to make billions and billions of dollars, when you have $80 billion and you want to put in a big position in a good company, that's just not going to happen, because you're such a big company already that a small position for you can end up buying basically pretty much almost all the company's worth in the business you want to invest in. So you don't want to do that, because you don't want to. That makes you the full owner, and you have to literally manage it as the CEO. So you're not for that. And plus, to get to that point, you have to literally obviously talk to the owners and the CEO to see if they allow you to do that. Because obviously, I mean, imagine you having a business and someone decides, I want to buy your business, but they didn't tell you and they just bought the whole business, right? So it's only if they agree with it. But even with that, that makes it even harder. 33% of 80 billion, let's say even 10% of that, that's about $8 billion. You see why the universe shrinks? Because that means you're not able to invest in companies that are worth 5 billion, 6 billion, 7 billion, 8 billion, because you would buy the whole business outright. In order to own, let's say, 5% stake in a business, and you want to put in $8 billion into that, that's a business that would have to be worth about $160 billion. And there's only a few companies in the whole world that have that amount of money in valuation. That's why the universe shrinks. And when you have, especially, a clientele where you have to sell them on saying that you're trying to give them a higher return, and why you have to convince them why it's safer and a good choice for them to lend their money to you, and so that you can utilize it and give a better return back to them. That's the problem with hedge funds. And that's why with hedge funds, they have to actively add in assets, even if there's not good investments out there, because they need to make their company's overview portfolio attractive for people to lend their money to them so they can get the train moving. Very big hedge funds, it comes to the point where they're not able to even find returns, right? Because you can't invest in everything. Like, you have to invest in really good companies. And when you have that much money, your universe really shrinks, because you're not able to invest the same amount as it used to be and not get able to get the biggest return. Because think about it, a 10% allocation of $80 billion is $8 billion, right? But if that's a lower allocation, automatically, if that company makes 1,000%, you'd basically you would double what you currently have in the whole fund, right? But that's pretty rare, at least for that isn't the case for all companies, right? Because there's not going to be that one great company in even when it has a high market cap, right? Because there's a reason why it's a high market cap. It took many times. I mean, many people looked at its growth when it was earlier. That's why it grew so much. Maybe it's getting close to its peak, to its top. It's not attractive as it used to be because that's why it went up so much, right? That's because people saw the potential there and it went to it should be. It's not that there's risk with it. It's just, it's like a slower company now. When hedge funds have this problem, they tend to, and I think hedge funds that don't even have this problem, they just get greedy. They tend to charge more interest to their customers relative. The returns in the total assets in their companies are making, let's say, lower returns. In a company, of course, the hedge fund is going to make, of course, lower returns as of themselves because their asset returns are deteriorating. So because of that, in order to recover and still be attractive for new clients, they tend to put in their sheets in their their very false, misleading thing that they charge interest to their clients and they provide that as income for their own portfolio. And many people think that, oh, okay, the bumped up returns went up. That's a good sign that the assets are doing well. That could be somewhat misleading because sometimes that could be the interest that they're charging the client themselves. And many of you might be saying like, wow, do they really? Yeah, they do. They do that. It's a business at the end. They're trying to get more people in. If you have $80 billion and $120 billion, you're not going to stop. You have such a responsibility, and it's just gonna be horrible if you don't do that. So you're obligated to do these things. So it's a self-reinforcing thing, and that's why the S&P is always going to outperform these people, and especially because you're not going to know with full certainty whether the business that you choose to have later on is going to have great returns and great returns. That's just not difficult, right? And as soon as you have more money in your bus, that return prospect gets harder. So if you're a very busy person, and let's say for some particular reason, I don't know why, but that's not personal, you don't want to invest in companies, you just want to find a way to generate growth for a very, very long time, really until you retire. That's really the huge gain that you do in the S&P 500 is to wait that long. You're going to get paid so ridiculously. You're going to be so much better off than putting your money anywhere else compared to a hedge fund or anything like that, is to put it into the S&P 500, and especially reinvesting dividends. Many people underestimate dividend reinvestment, and I think that's just because they're mislooking that. But dividend reinvestment has a ridiculously compound interest that your return without dividends looks like you shouldn't, even though it's like you shouldn't even invest in the S&P 500, because the difference between the dividends returns with the S&P compared to without dividends is just ridiculously far apart. I mean, it's a completely different game. Since 1928, the S&P 500 before inflation has made about 17,000% return until now, and as the index price. If you would have reinvested dividends, you want to know what that return is? That's about 525,000% return. That's like comparing a fish with a whale. Like that's a completely different game. And many people underestimate dividends. So this is the case with indexes, and that's the case with companies. That doesn't mean that you should only look at companies for dividends. That's not what I'm saying. But I'm just saying that if the company that you're investing in just so happens to have dividends, please reinvest those dividends, because that's free incentive yield in a way. The whole reason why companies pay dividends is to attract more people to hold their stock, to keep their equity in that way. That helps the company use that fund, right? Because that's the whole point. And many companies that are not even big dividends still do pay you dividends. And even if it's a small amount, guys, a small amount, even in the S&P 500, a small amount is not a small amount when you hold the security for 15 to 20 years. And it's not even the security, it's the stock. If you hold the S&P 500, Dow Jones, or the company that you want to hold, if you hold it for 15 years, you're gonna see a huge difference if you reinvest dividends, because of the compound interest. The compound interest is a gold in this world. If you have compound interest, you're able to beat all the assets that you could possibly think of, and especially inflation. It's highly silly that people do not calculate inflation as a depreciating factor to their return. I mean, that's complete nonsense. That's like going to the bathroom, doing number 2, and not even flushing the toilet, and you're complaining why it smells bad, right? That's how stupid it is. Like, if you don't calculate inflation, I don't even know what world you're living in. Inflation is going to last forever. Inflation will always be here. If you calculate a return and you don't calculate an inflation, I mean, you got to understand that the money you have tomorrow and the money you have in the next couple of years is always going to be worth less compared to now, because inflation is always going to exist, because the economy is always going to face short-term consequences, because everything that happens in the world, right? Whether it's geopolitically, whether it's supply and demand, all these types of things are going to affect the economy, and that outcome is going to affect marketable securities to come down. And that's going to also give you a huge opportunity to buy, but it's also going to increase inflation. That's going to increase that wealth gap between very wealthy people who have many assets and the many poor section that don't have assets and just have a job, right? And that's just unfortunately the way how it is. That's why cash is literally the worst thing you can ever do to stay dependent, right? It's just the way how it is. And I'm going to show you why. But yeah, this is the starter of this lesson. Even if you've been in the markets for so many years, this is going to give you such a clarity, even what I'm going to show you in the next video. All right. So that's for now. I'll see you guys in the next part.